The ABC of Stock Speculation by S.A. Nelson, New York. Copyright 1902. Preface. Following the publication of the ABC of Wall Street, there were many requests for a book dealing with the principles governing stock speculation. If there is one man better qualified than another to produce such a book, that man is Mr. Charles H. Dow. Several attempts were made to have him write the desired volume, but they were unavailing. From time to time in his Wall Street career, extending over a quarter of a century, Mr. Dow has carefully evolved his theories of successful stock speculation. They are to be found in chapters 4 to 20 inclusive, and can be commended to anyone interested in stock speculation as remarkable for their grasp of a subject about which so little has been written and so much misinformation is gratuitously offered the public. In the preparation of this little volume, thanks are also due to the Wall Street Journal, the Evening Post, the Dow Jones & Co.'s news agency, Mr. Alexander Dana Noyes, Mr. Daniel Kellogg, Mr. E. W. Hardin, and a number of brokers and speculators. The reader, of course, understands that there is no royal road to success in speculation. It would be fallacy to undertake to show how money can be made. No infallible plan has yet been discovered. Experience and observation, when intelligent, however, are valuable, and we are of the opinion that the average speculator will find a study of the following pages to be useful and profitable. Etymological authorities are not an entire accord respecting the origin of the word broker. Jacob's Law Dictionary says, the etymology of the term broker has been variously given. By some it has been derived from the Saxon brosach, misfortune, as denoting a broken trader, the occupation being formerly confined, it is said, to unfortunate persons of that description. According to others, it was formed from the French troyeur, or grinder, or breaker into small pieces, a broker being one who heats or draws a bargain into particulars. Terme de la lieu, call. The law Latin from erocator, however, seems to point distinctly to the Saxon erocan, to break, as the true root, which in the old word abroachment, q versus, or abroachment, had the sense of breaking up goods or selling at retail. A broker, therefore, would seem to have been originally a retailer, and hence we find the old word auctionarius, q versus, used in both these senses, barrels ladiat, teat, broker. Worden gives as the derivation of the word the French brochoir and the Latin treater, a person who breaks into small pieces, war, ladiat, teat, broker. Webster gives as its derivation the Old English brocaur, Norman French ragor, French brocanteur. Under the word broke, to deal in second-hand goods, to be a broker. Webster says it is probably derived from the word Iraq. Worcester derives it from the Anglo-Saxon erokan, to discharge an office, erokian, to press, and the French royer, to grind. See broke and broker.
The word broker seems first to occur in literature, in Pierce Plowman, among burgesses have I be dwelling at London, and gart backbiting be a broker, to blame men's wear. It clearly means here a fault finder, as in Provençal, rack is refuse. The broker was originally one who inspected goods and rejected what was below the standard. Wedgwood, crabs, dig, of stat, tit, Brokers 261 says, there were a class of persons known to the yeomans who were deemed public officers and who united the functions of bankers, exchangers, brokers, commissioners, and notaries all in one under the description of croxnetai. As early as 1285 in England, the term broker occurs in an Act of Parliament. It enacts that there shall be no broker in the city, London, except those who are admitted and sworn before the warden, mayor, or alderman. John R. dos Passos, an authority on stock exchange law, says, the next statute, passed in the reign of James I, more than 300 years later, 1634, regulates the calling of brokers with greater detail than the first act, and clearly shows, by the use of the words merchandise and wares, that down to this period, the broker in money, stock, and funds had no legal existence. It was not until the latter part of the 17th century, when the East India Company came prominently before the public, that trading or speculating in stock became an established business in England, and the term broker, which had then a well-understood meaning, was promptly transferred to those persons who were employed to buy or sell stocks or shares, and who thenceforth became known as stockbrokers. In 1697, owing to the unjust practices and designs of brokers and stock jobbers in selling tallies, bank stock, bank bills, shares, and interest in joint stock, a stringent act was passed permitting only sworn appointees to act as brokers. In the reigns of William III, Anne, and George, statutes were passed regulating the practice and trade of brokers.
An early legal writer describing stockbrokers said, stockbrokers are persons who confine their transactions to the buying and selling of property in the public funds and other securities for money, and they are employed by the proprietors or holders of the said securities. Of late, in recent years, owing to the prodigious increase of the funded debt of the nation, commonly called the stock, they are become a very numerous and considerable body, and have built by subscription a room near the bank wherein they meet to transact business with their principals and with each other, and to prepare and settle their proceedings before. They go to the transfer offices at the bank, the South Sea and India houses, thereby preventing a great deal of confusion at the public offices, where the concourse of people is so great during the hours of transferring stock, that if the business was not prepared beforehand, it would be impossible to transact it within the given time. The advantage of having a broker as an intermediary was recognized by merchants many centuries ago. A 16th century writer on the law says, "It is an old proverb, and very true, that between what you will buy and what you will sell, there is 20 in the 100 differing in the price, which is the cause that all the nations do more affect to sell their commodities with reputation by means of brokers than we do. For that which seems to be gotten thereby is more than double lost another way. Besides that by that course many differences are prevented, which arise between man and man in their bargains or verbal contracts, for the testimony of a sworn broker and his book together is sufficient to end the same." Dealings in stock certificates constitute the main business of stockbrokers, but the origin of stock certificates has not been satisfactorily traced beyond the middle of the 17th century. Property in this form was not known to the ancient law. While mercantile or commercial corporations existed among the yeomans, history gives us no information regarding their character or methods of conduct. Bruges and Amsterdam contend for the honor of having erected the first bourse. The Roman law, says John E. Dos Passos, required 3 persons to organize a corporation, and as each body had at least that number of members, if not more, it would seem but natural that a certificate which was to be given to the first bourse should be given to the second bourse. A certificate or some other substantial muniment of title should have been issued by the corporation to its respective members in which the proportion of interest of each in the capital or corporate property of the association appeared.
But whether a certificate was, in fact, issued, and if so, was regarded as property capable of sale or other negotiation, and of vesting in the representatives of the owner on his decease, or whether the corporations were all of the nature of guilds, conferring upon the members mere personal rights, all of these questions seem now to be incapable of solution, and the yeoman law, which sheds such floods of light upon commercial subjects, apparently leaves the above matters in total darkness. In England, in 1770, Lord Mansfield, in a case wherein it was contended that stock certificates were money, decided against that view, saying, "This is a new species of property, arisen within the compass of a few years. It is not money." The stock exchange, or bourse, in its present use, is a modern creation. Brokers and dealers in stocks and merchandise dealt together in an exchange in Cornhill, London, in 1670 or thereabouts. In 1698, the stockbrokers of London obtained quarters for their exclusive use. The first stock exchange formed in the United States was that of Philadelphia, where a board of stockbrokers formally organized and adopted a constitution in the early part of the 18th century. The New York Stock Exchange, framed on the plan of the one in Philadelphia, was organized in 1817, but curiously enough, this institution is in possession of a document bearing date May 17, 1792, signed by a number of brokers, in which it is stated, "We, the subscribers, brokers for the purchase and sale of public business, agree to do business at not less than 1/4 of 1%. Medbury, in his Men and Mysteries of Wall Street, describes early stock speculation in this country as follows.
When Washington was president and continental money was worth a trifle more as currency than as waste paper, some 20 New York dealers in public stock met together in a broker's office and signed their names in the bold, strong hand of their generation to an agreement of the nature of a protective league. The date of this paper is May 17th, 1792. The volume of business of all these primitive New York brokers could not have been much above that of even the poorest first-class Wall Street house in our time, 1870. The revolutionary shin plasters, as the irreverent already styled them, were spread over the land in such plenty that there were $100 to each inhabitant. Something was to be made, therefore, from the fluctuations to which they were liable. Indeed, one of the greatest broker firms of subsequent years derived its capital from the lucky speculations of its senior member in this currency. The War of 1812 gave the first genuine impulse to stock speculation. The government issued 16 millions in treasury notes and put loans amounting to 109 millions on the market. There were endless fluctuations, and the lazy-going capitalists of the time managed to gain or lose handsome fortunes.
Bank stock was also a favorite investment. An illustration of one of the sources of money-making to brokers at this period is found in the fact that United States successes of 1814 were at 50 in specie and 70 in New York bank currency. In 1816, one could count up 200 banks with a capital of $82 million.
One day in 1817, the New York stock dealers met in the room of an associate and voted to send a delegate over on the stage line to investigate the system adopted in the rival city, Philadelphia. The Philadelphia visit was successful, and the draft of a constitution and bylaws framed from that of the Philadelphia Board received the final approbation of a sufficient number of brokers to enable the New York Stock Exchange to become a definite currency. 3 years after, on the 21st of February, 1820, this preliminary code of rules received a thorough revision, and the organization was strengthened by the accession of some of the heaviest capitalists in the city. Indeed, with 1820, the real history of the exchange may properly be said to commence. In Europe, stock speculation historically was marked with white stones won by the tulip craze, the South Sea bubble, the John Law inflation in France, and later by the wild PJ acculation in Kafirs. In this country, for more than half a century, stock speculation had its basis in the securities of the steam railroad. It has ebbed and flowed with the promotion, construction, decline, and reorganization of that industry. In the last decade, speculation has been fostered by the industrial proposition, which has resulted in offering to the public shares of industrial corporations. Not an industry has been passed by.
Like the railroad, the industrial corporation is destined to have its periods of promotion, construction, decline, and reorganization. It will not be difficult for the reader to determine which period he has under immediate consideration. Stock speculation. For many years, stock speculation has been of national and absorbing importance. During the period from 1896 to 1902, investment and speculation in corporate securities attained an unprecedented importance, owing to the general movement to combine and incorporate industrial companies with a consequent change of ownership. Ownership, which had been vested in small groups of individuals, now became widely distributed. Where an industry had been controlled and owned by 10 persons, the number multiplied and increased by 10 and 1,000-fold through the medium of share ownership. The mine and the factory owned by the individual were merged into a joint corporation, the shares of which were listed on the stock exchange and offered to the public for investment or speculation. The United States Steel Corporation has more than 40,000 stockholders, the American Sugar Refining 11,000, while other corporations, notably those representing the railroad, are relatively as widely distributed. Stock speculation in the United States in the period named was also inspired by the rehabilitation of the railroad industry, the stocks of which have always been favorite speculative fuel. And the basis for the intense public interest and activity was the general prosperity and wealth of the country. A variety of causes contributed to the tremendous increase in national wealth. Today, speculation in the shares listed on the New York Stock Exchange is not only confined to New York, but extends to California on the west, Canada on the north, Texas on the south, and London, Paris on the south. The telegraph, telephone, and cable wire transmits quotations to facilitate speculation today with a speed and perfection of method that would have been regarded as marvelous by the founders of the New York Stock Exchange and quite impossible by the great manipulators who dominated the arena a quarter of a century ago. Millions of dollars are consumed annually in order to keep the machinery of Wall Street in working order. It is estimated that the annual expenses of 300 leading Wall Street stock firms approximate $15 million. In view of the commercial and economic tendencies of the times, the indications are that stock speculation will continue to play a highly important part in the country's trade. In 1931, there were days when dealings on the stock exchange exceeded 3 million shares, and the machinery of speculation threatened to break down under the intensity of the strain to which it was subjected. Whether the records of that year will ever be broken, no man can foretell. But it is reasonable to say that not for a long time will interest in the daily changes of the stock market be confined solely to the ranks of the professional stock speculator who conducts his operations within stone's throw of the stock exchange. For there has arisen a vast army of investors and speculators who are deeply interested in the day's price fluctuations. Stock speculation and gambling. Is there any difference between speculation and gambling? The terms are often used interchangeably, but speculation presupposes intellectual effort, gambling blind chance. Accurately to define the two is difficult. All definitions are difficult. Wit and humor, for instance, can be defined, but notwithstanding the most subtle distinction, wit and humor blend, run into each other. This is true of speculation and gambling. The former has some elements of chance, the latter some of the elements of reason. We define as best we can. Speculation is a venture based upon calculation. Gambling is a venture without calculation.
The law makes this distinction. It sustains speculation and condemns gambling. All business is more or less speculative. The term speculation, however, is commonly restricted to business of exceptional uncertainty. The uninitiated believe that chance is so large a part of speculation that it is subject to no rules, is governed by no laws. This is a serious error. A broker is a trader, a speculator, or a manipulator, a gambler, or are all four gamblers. An old speculator takes this somewhat humorous view of the question. I am not a gambler. The broker is the gambler. I am the filled square lamb, unshorn, it's true, but nevertheless the victim of a bad habit. If I enter a gambling house and make a few wagers, I would resent the imputation that I was a gambler.
I am not a gambler, or at the worst only an amateur at the game, and then for a few minutes only. The man who backs the game and runs the gambling house is the professional gambler. Now, the broker occupies much the same relationship to the stock gambling game that the man with the cards and wheeled is to his peculiar trade. Of course, behind the stockbroker there is the manipulator and the game itself. The broker does not lose out his own money unless he buckets his orders when he is a gambler, as is every bucket shop operator. So he is only a croupier, so to speak, for the game. A stock speculator whose only source of income is stock speculation on a margin may fairly call himself a gambler. Speculation and gambling, as the words are used today, are substantially interchangeable, but nevertheless there is a marked distinction between the two. All speculators are not necessarily gamblers, although all stock gamblers, traders, are speculators. When speculation in stocks becomes gambling in stocks, the operations are usually confined to transactions made on a margin. For example, A walks in a broker's office and asks, "What do you think of the market?" "We hear," is the reply, "that Street Paul is a purchase at the opening for a rise of several points." "Very well,
Buy me 100 shares, sell at 2 points profit.
And stop the loss at 1 point. Obviously, this is a wager in which the gambling factor is very strong and the maker regards himself as a gambler. Example, B enters the same office, asks the same question, receives the same reply, and says, "Very well, buy me 100 shares, send the certificate to my office, and I will give you a check for it." B buys his stock outright and would not buy a single share on a margin. He will admit that he is a speculator, but will be insulted if you call him a gambler. Example number 3, C is a trader and an exchange member. Ask him his business, and he will reply that he is a trader. Ask him to define a trader, and he will say, "As far as I am concerned, a trader is a gambler."
I never go long or short a share of stock. I take advantage of the smallest changes in the market, limiting my losses to the minimum Chirac and 4 Chirac A, and take equally small profits, although I am glad to get larger ones. I excel at calling the successive changes, trade on either side, and have no pronounced views as to whether it is a bull or bear market. All bucket shop operators and traders are gamblers. Investors are not gamblers. Brokers and manipulators are not necessarily gamblers, the circumstances governing individual cases. The case of B will doubtless cause discussion, but his view is that he is no more a gambler than the man who buys a parcel of real estate on a 10% equity, or the merchant who buys and sells goods in expectation of a rise or a fall. But stock speculation does not owe its importance to the classes of speculators enumerated as closely allied to the gambler. On the contrary, they are in the minority. Gambling may at times be an unavoidable accompaniment of stock speculation, but stock speculation is so interwoven with the money market and the commerce of the country that to eliminate it from the world of business would be for civilization to take a long backward step.
Criticism of stock speculation, as of other trades, arts, and sciences, to be intelligent should be discriminating. Pulpit and press at times denounce stock speculation as if the stock exchange and Wall Street were hotbeds of corruption. No well-informed man questions the usefulness of the stock exchange or stock speculator. Stock exchange prices register values and the state of trade precisely as a thermometer registers heat or cold. The stock market is the most highly organized and delicately adjusted market in the world. It offers to the public at large securities which are good collaterals at any bank and securities which on any business day can be sold for cash. It gives the money market great elasticity. It is a safeguard provided for unexpected demands upon the money market and furnishes a medium of exchange that minimizes the use of gold in international operations. It is a most important part of the modern system of credit. Eliminate the stock market and transferable securities from the life of the country today and contemplate if good can be the result of a demand from Europe for its credit balances to be paid in gold. The result would paralyze industrial progress. The stock exchange facilitates the employment of capital, adds to its productiveness, is an accurately registering machinery of credit indispensable to the banks of the country, and is a guiding force for the merchant and financier.
The Morality of Wall Street, a leading newspaper, commented 1903 editorially on the morality of Wall Street. Part of the burden of its comment was that it was different in some respects from morality elsewhere, taking the word morality to mean in this instance the general law or code of ethics obtained.
In Wall Street and elsewhere, it does not appear that there is any essential difference between Wall Street morality and general business morality. The object of all business is the making of money and nothing else. Wall Street is certainly no different from any other place or center of business activity in this respect. Where one business center or group of industries differs from another in the matter of morality is probably only in the details of its code. Now, in the details of its code, Wall Street will compare to advantage with most other business centers.
As has been pointed out, its machinery is predicated upon rigid observance of bargains made in word past. While it is true that this kind of honor is absolutely necessary for the smooth conduct of business as it is carried on in Wall Street, it is also true that the high standard required is lived up to by the street, and breaches thereof are extremely rare. Perhaps one reason why there is so much disposition to question the morality of Wall Street and contrast it unfavorably with the morality of other business centers is the fact that in Wall Street, probably to a greater extent than elsewhere, the primal passions and instincts of acquisitiveness and self-preservation wear less disguise than they do in the other channels of industry and money-making. A stock exchange anywhere is a theater in which these primal passions battle as gladiators in the arena without concealment or pretense. Everyone who goes down into the arena knows that it is a battle wherein his hand must keep his head, and the penalty of failure will be exacted against him to the utmost. "A lagar cum a lagar" is a proverb that very well describes the conditions under which business is done in Wall Street. Elsewhere, it may appear to be different. The only difference is that in Wall Street there is no pretense, no disguise. The essential struggle is the same everywhere. In Wall Street, there has been, and unfortunately still is at times, fraud in detail peculiar to Wall Street, but it is not of Wall Street nor inherent in the laws of the game. It is true that speculation in Wall Street is looked upon as being especially immoral by comparison with speculation elsewhere. It is, however, JRD of almost every manufacturer's business or of every merchant's business to speculate. No one thinks of finding fault with either for doing so. In Wall Street, speculation stands alone, without any business disguise for all men to see. There is no difference between one kind of speculation and another so far as essence is concerned. The only difference is that one is disguised and the other is not. It may be noted, moreover, that where the speculation is not disguised, it is apt to be more honest than where it hides under a cloak of business enterprise. All men are gamblers and always will be, more or less, for the get-rich-quick idea and the chances of something for nothing. All men will always prove irresistibly attractive to human nature.
The plain fact of the matter is that the general suspicion of and hostility toward Wall Street find their root in the fact that the race for money is carried on simply, openly, in the light of day, without pretense or hypocrisy of any kind, and without attempt to cloak the passions that have existed since man first came upon the earth. If gambling be wrong, the principal charge that can be levied against Wall Street is that it is there carried on openly, under simple but rigid rules, and Wall Street does not care who knows it. Elsewhere, it goes on in essence just the same, but disguised in a multitude of ways. In these days, most forms of business must, of their very nature, contain a large element of speculation.
We do not see that speculation becomes more immoral by being openly carried on. Wall Street has rather less use for an habitual liar than have other places. It has no use at all for a man who does not keep his word. It may be true that honesty is the best policy in Wall Street simply for reasons of convenience, but that it is the best policy no one can deny. In fact, it is the only policy that in the long run is successful.
We do not think that this is necessarily an argument against the morality of Wall Street. Scientific speculation. The question whether there is such a thing as scientific speculation is often asked. Various answers of a somewhat affirmative character have been given, but they have generally been hedged about with so many qualifications as to be nearly useless for practical purposes. The experiences of operators have, however, crystallized into some general rules worth heeding. The maxim, buy cheap and sell dear, is as old as speculation itself, but it leaves unsolved the question of when a security of a commodity is cheap and when it is dear, and this is the vital point. The elder Rothschilds are said to have acted on the principle that it was well to buy a property of known value when others wanted to sell, and to sell when others wanted to buy. There is a great deal of sound wisdom in this. The public, as a whole, buys at the wrong time and sells at the wrong time. The reason is that markets are made in part by manipulation, and the public buys on manipulated advances and after they are well along.
Hence, it buys at the time when manipulators wish to sell and sells when manipulators wish to buy. In some commission offices, there are traders who, as a rule, go against whatever the outside customers of the house are doing. When members of the firm say, all our customers are getting long of stocks, these traders sell out, but they buy when the firm says the customers are all short. There are, of course, exceptions to this rule. If there were no exceptions, the keepers of bucket shops would all get rich. When the market has an extraordinary rise, the public makes money in spite of beginning its purchases at what would ordinarily be the wrong time. And this is when the bucket shops either lose their money or close out in order to keep such money of customers as they have in hand.
All this points to the soundness of the Osroth principle of buying a property of known value when the public generally is disposed to sell, or of selling it when the general public thinks it a time to buy. Daniel Drew used to say, cut your losses short, but let your profits run. This was good preaching, BVIT. Uncle Dan did not, in his later years, practice his rule when it would have been better for him if he had. The thought here is unquestionably one of the sound principles in trade. It means that if a stock has been purchased and it goes up, it is well to wait. But if it goes down, it is well to stop the loss quickly on the ground that the theory on weekly the purchase was made was wrong. The public as a whole exactly reverses this rule. The average operator, when he sees 2 or 3 points profit, takes it. But if a stop goes against him 2 or 3 points, he holds on, waiting for the price to recover, with oftentimes the result of seeing a loss of 2 or 3 points run into a loss of 10 points. He then becomes discord, aged, and sells out near the bottom to protect the margin in which he has left. How many operators, in looking over their books, find a considerable number of small profits swept away by one large loss? When a trader finds by his accounts that his profits have been relatively large and his losses relatively small, he can make up his mind that he is learning how to trade. The trouble with carrying out this plan is that a series of losses of from 2 to 2 points are very discouraging. A trader who sees that he has taken twice or 3 times a loss of 2 points when, if he had waited a few days, he need not have taken any loss, is very apt to decide that he will not cut his losses short anymore, but will wait, and this is the time when the recovery does not come. Mr. J. Gold said his policy was to endeavor to foresee future conditions in a property and then, having made his commitments carefully, to exercise great patience in awaiting results.
This also is sound doctrine, but proceeds along very different lines. Assuming the ability to foresee the future, it is the wisest of all courses. But many who have tried this method have found that the omission of essential factors made their forecast valueless, and both filled square their courage and their patience of little avail. Nevertheless, this method should not be discarded on account of the difficulties involved. Within limitations, the future can be foreseen. The present is always tending toward the future, and there are always in existing conditions signals of danger or encouragement for those who read with care. Diamonds suit the two general methods of trading. There are two general methods of trading. One is to deal in active stocks in comparatively large amounts, relying for protection upon stop orders.
In this method of trading, it is not necessary to know much about the values. The point of chief importance is that the stock should be active enough to permit the execution of the stop order at the point selected so as to cut losses short. The operator, by this method, guesses which way the stock will move. If he guesses right, he lets his profits run. If he guesses wrong, he goes out on the stop order. If he can guess right as often as he can guess wrong, he is fairly sure of profits. The other system is an entirely different proposition. It starts with the assumption that the operator knows approximately the value of the stock in which he proposes to deal. It assumes that he has considered the tendency of the general market, that he realizes whether the stock in which he proposes to deal is relatively up or down, and that he feels sure of its value for at least months to come. Suppose this to exist. The operator lays out his plan of campaign on the theory that he will buy his first lot of stock at what he considers the right price and the right time, and will then buy an equal amount every 1% down as far as the decline may go. This method of trading is the generally employed by large operators.
They know the value of the stock in which they propose to deal and are therefore reasonably secure in following a decline. They feel about a stock as merchants feel about buying staple goods. If an article is cheap at $100, they know it is cheaper at $90 and will strain a point to buy at $80 or at $70, knowing that the price must recover. This is the way a large operator looks at his favorite stocks, and this is why he generally makes money in them. The disadvantage of the small operator in following this method is twofold. He does not absolutely know the value of the stock. That is, he may know the truth up to a certain point, but beyond that is an unknown factor which interferes with the result. When the price of a stock declines considerably, the small operator always fears that he has overlooked something of importance, and he is therefore tempted to sell instead of averaging his holdings. The second disadvantage of the small operator in full following this policy is that he seldom provides sufficient capital for his requirements. Thousands of speculators believe that because 10% is a common speculative one margin, that $1,000 justifies them in trading in 100-share lots. This impression produces losses continually. The man who has $1,000 for speculation is not well equipped for trading in even 10-share lots if he proposes to deal on a scale.
A comparison of high and low prices of active stocks shows frequently a difference of 30 points in a year. Any operator proposing to follow a stock down buying on a scale should make his preparations for a possible fall of from 20 to 30 points. Assuming that he does not begin to buy until his stock is 5 points down from the top, there is still a possibility of having to buy 30 lots before the turn will come. If, however, an outsider will provide $2,500 as his speculative capital and will trade in 10-share lots in a thoroughly good railroad stock, beginning his purchases only after a decline of 5 points in a rising market and 10 points in a bear market, following the decline with purchases every point down and retaining all the stock bought, he seldom need make a loss.
Such campaigns require time, patience, and the pursuance of a fixed policy. But whoever will follow this policy will find himself able to get a high rate of interest on the capital invested. It is an old saying in Wall Street that the man who begins to speculate in stocks with the intention of making a fortune usually goes broke, whereas the man who trades with a view of getting good interest on his money sometimes gets rich.
This is only another way of saying that money is made by conservative trading rather than by the effort to get large profits by taking large risks. After allowing for all the risks involved, we think the outsider who wants to trade in stocks has a better chance working in small lots on a scale than in any other way, provided he will pay attention to certain essential points, which, for convenience of reference, we will enumerate in order. 1. Bull markets and bear markets run 4 and 5 years at a time, determined by the average prices which one is underway. 2. Determine the stock or stocks to trade in. They should be railroad stocks, dividend payers not too low nor too high, fairly active, and for the bull side below their value, for the bear side above their value. Values are Duffield square termed roughly by the earnings available for dividends. 3. Observe the position of your stock with relation to recent fluctuations. In a bull market, the time to begin to buy is when a stock has had 4 or 5 points decline from the last previous top. In a bear market, the time to begin to sell is when such a stock has had 3 or 4 points rally from the bottom. 4. Stick to the stock bought until a fair profit or until there is good reason for deciding that the first estimate of value was wrong. Remember that an active stock will generally rally from percent to percent of the amount of its decline under adverse conditions and more than that under favorable conditions.
5. Have money enough to see a decline through without becoming uneasy or overburdened. $2,500 ought to take care of a 10-share scale every point down. That is to say, supposing the first lot to be bought 5 points down from the top, $2,500 ought to carry the scale until the natural recovery from the low point brings the lot out with a profit on the average cost. It will not do to expect a profit on every lot, but only on the average. In a bull K market, it is better to always work on the bull side. In a bear market, on the bear side. There are usually more rallies in a bear market than there are relapses in a bull market. 6. Do not let success in making money in 10-share lots create a belief that a bolder policy will be wiser and begin to trade in 100-slayer lots with inadequate capital. A few 100-share losses will wipe out a good many 10-share profits. 7. There is not usually much difficulty in dealing in 10-share lots on the short side. If one L-carat broker does not wish to do it, another probably will, especially for a customer who amply protects his account and who seems to understand what he is doing. Diamond Suit, 3 general lines of reasoning.
We have spoken in a preceding article of the fact that the experience of great interests in the market seems to have crystallized into 3 general lines of reasoning. The first is that the surface appearance of the market is apt to be deceptive. The second is that it is well in trading to cut losses short and let profits run. The third is that correctly discounting the future is a sure and easy road to wealth. The problem is how these rules, which are undoubtedly sound, can be operated in a practical way. Let us take first the action of the general market with reference to the time to buy. The market is always to be considered as having 3 movements, all going on at the same time. The first is the narrow movement from day to day. The second is the short swing, running from 2 weeks to a month or more. The third is the main movement covering at least 4 years in its duration. The day-to-day movement should be disregarded by everybody, except traders who pay no commissions. The medium swing is the one for ordinary consideration.
It is therefore generally wise to look for a low point on a decline. Suppose, for instance, that Union Pacific was the stock under consideration, that it was clearly selling below its value, and that a bull market for the 4-year period was underway. Assuming further that in a period of reaction, Union Pacific had fallen 4 points from the previous highest. Assume earnings and prospects to be favorable and the outlook for the general market to be about normal. This would be the time to begin to buy Union Pacifics. The prudent trader, however, would take only part of G's line. He would buy perhaps 1/2 of the stock he wanted, and then give an order to buy the remainder as the price declined. The fall might go much further than he anticipated. It might be necessary to wait a long time for profit. There might even be developments which would make it wise to throw over the stock bought with the hope of replacing it materially lower. These, however, are all exceptions. In a majority of cases, this method of choosing the time to buy, founded upon clear perception of value in the stock chosen and close observation of the market swings underway, will enable an operator to secure stock at a time and at a price which will give fair profits on the investment.